For the past several months, Congress has been at odds over interest rates for the Stafford student loan. The loan is a major source of funding for many families sending their children to college. Winona State University Financial Aid Director Greg Peterson tries to shed some light on the impact the proposed rate increase would have.
Well, we're really dealing with three programs: the subsidized direct loan, the unsubsidized direct loan, and the federal parent loan. And interest rates are being determined for all three of those programs. Let's just take the subsidized direct loan as an example. The federal government serves as the lender. The results of the FAFSA determine a student's ability to borrow either from the subsidized component of the program and the unsubsidized component of the program, or perhaps only the unsubsidized component. What subsidized means is that the loan is interest-free while a student is enrolled in school. What unsubsidized means is that a student pays interest on the loan while they are enrolled. In any event, a student pays the interest that Congress is talking about now after graduation during the repayment period. Last year, July 1 of 2012 through June 30 of 2013, the interest rate was 3.4%. If a student, again, if a student is during the enrollment period on a subsidized loan, the interest rate is 0 until the student graduates and goes into the repayment. But at that point, the interest rate was 3.4%. Effective July 1, without action, without congressional action, that interest rate went to 6.8%. Now, with the legislation that's being proposed, has been passed in the Senate and is now being examined in the House, the interest rate would be, for the July 1, 2013 through June 30, 2014 period, the interest rate would be 3.86%. So if we, based on last year's interest rate versus this year's interest rate, the rate would be higher by 0.4%. But assuming that we're talking about what's currently in the legislation, 6.8%, that rate would go from that level down to 3.86. So it's very close in terms of the characteristics. We'd probably be seeing something like maybe $8 or $9 a year between the 3.4 and the 3.86% on a $2,000 loan, for example, that would accumulate. So the concern is really, number one, that the 6.8% interest rate go away before the academic year begins. That's the hope. Secondly, the issue is that the rate has been a fixed rate historically. Now it will continue to be a fixed rate for a loan that a student takes out in a particular year. So if a student were to take out a loan next year at 3.86%, when they graduate and begin the repayment, that loan for this year would be at 3.86%. Now they might take out a different loan the next year with a different interest rate. But this year's loan would be a fixed loan at 3.86%. Well, the Minnesota Office of Higher Education has done a study on the indebtedness that students have borrowing at Minnesota schools specifically. And Winona State's indebtedness is at about $22,600 in terms of the borrowing that students have done while they attend Winona State. The Minsky State University average is about $23,800. So we're kind of right in the range of what the other institutions have. Winona State is one of the leaders in the Minsky system in terms of default rate. Our default rate is around 2.5%, so it's very low. And our students, basically repay their loans very effectively. So we're, I guess, pleased with the way in which that has gone.
Well, since we spoke with Mr. Peterson, President Barack Obama has signed a bipartisan bill to reform the federal government student loan system. The law will fix student loan interest rates to the 10-year U.S. Treasury note instead of using the current arbitrary formula. The law also establishes interest rate ceilings and locks interest rates for the loan's lifetime. Also, interest rates for undergraduate students during the upcoming 2013-14 academic year will drop from 6.8% to 3.86%. The law also retroactively applies to loans taken out after July 1st, when interest rates on the federal Stafford loans doubled after Congress failed to prevent the expiration of subsidies. Now, the legislation is projected to provide $25 billion in debt relief for students over the next 5 years.